Hello and welcome to CIMA F1 Financial Operations Chapter 2, where we'll cover IAS 1 presentation of financial statements. Now, as management accountants, you are in a position to have to understand financial operations of a business, and the way you analyze financial operations is looking into the financial statements. So imagine in this paper you will basically be tested one way or another, your familiarity with how financial statements look like, how they comprise, why they're presented the way they're presented. So if you move in your express notes towards page 12, I assume all of you have in front of you these notes, which you can download from our website, where you obviously access this recording. Go to page 12 and let's go through what an annual report or a comprehensive set of financial statements comprises. So you may all hear and have to become familiar with what used to be called a balance sheet and now is called a statement of financial position. As a recap, in our framework in chapter 1, we are touching upon assets, liabilities and equity that are the elements of your statement of financial position. So assets, liabilities and equity. Another financial statements, very crucial for decision making for various stakeholders, is what used to be called profit and loss account or profit and loss statement, but currently called statement of comprehensive income. And as you may guess, here you would have income and expenses clustered together, and the difference between them would result into a profit or a loss that the company records for a specific period of time. A third financial statement would be statement of changes in equity, and you can abbreviate it as such, SOCE. And this statement probably is quite explicit by its name. It's probably of most interest to shareholders as such, reflects the movement in equity from the beginning to the end of the accounting period. Then you have another very important financial statements. Maybe in today's times people think one of the most important, statement of cash flows. As you can imagine here, this particular statement would reflect the inflows and outflows in terms of cash of a corporation for a period of time, and the difference between inflows and outflows highlighting the net surplus or deficit in terms of a cash position that the company has for that period of time. So statement of cash flow, that would be the fourth, and ultimately a comparative data for the previous year for each of the above. So in effect, imagine the statements above for the current period for which financial statements are prepared, and having the comparative year, the previous year, next to them, so that it allows you as a management accountant or you as a stakeholder of any form to be able to make a minimum comparison between where you are compared to your previous period of time. In addition to all these, here you will see that an annual report would comprise the famous disclosures. I'm sure you heard about disclosures or notes to the financial statements that would help to provide explanations to stakeholders, make information more understandable, like it's been pointed out in chapter 1 in the framework document of the standards, and basically just give a complete picture where the company is in terms of their financial operations. Now, I strongly urge you to think of a company you really like, one of these large companies, say Coca-Cola or Heineken, or just one of these big names, or maybe you're smoking and you like cigarettes, so look at BAT or JTI or Philip Morris, any company really that is large enough, and just Google their annual reports for a real feel of what these annual reports are all about, and you will come across this glossy set of financial statements with huge amounts of disclosures and notes, and of course various other bits and pieces of information which at this stage you don't necessarily need to know for the exam, but that sort of annual report will give you a fantastic real feel of how these four financial statements plus the comparatives plus the disclosures would look like. Now, in terms of some core concepts that you'll have to keep in mind when financial statements are prepared, you have at page 12 going to 13 a set of such information. Now, a few of them you already heard about at the framework, within the framework document in chapter 1, and maybe those of you who looked at that video already, you remember we mentioned true and fair view. So what is fair presentation? Fair presentation refers to when information is neutral, is free of bias, and you have as accurate as possible estimates. And we are using the example of provisions, which you may know that they are estimations, or of accruals that they are estimations, and it's not about how true they are because they're estimates, but they have to be done on a fair basis, so they should have a fair reflection of the underlying event that you provide for. So this, you heard already, is the overlap with the framework. However, the going concern concept is very, very important, and we haven't touched upon in the framework document, but IAS 1 says that the financial statements have to be prepared assuming that the entity will continue to trade in the foreseeable future, which means that, for instance, when the management is submitting these financial statements, based on their experience and responsibility, they are having an implied knowledge that this business will continue for, well, what is foreseeable future? Again, from best practice, you'd expect that to be the very next year at least. So it's hard to read the future, it's hard to guarantee that the business will exist in 20 years time from now, but the management has the responsibility to prepare financial statements knowing that it exists in the near future, and that would be, from best practice, about within the next year. So in case the management feels otherwise, feels that this company may not exist within the next year, may go bankrupt, let's say, or have big issues of liquidity, then the financial statements will be prepared on a different basis. But what we are looking on in the context of this paper is preparing financial statements based on the going concern principle. Another part which is very, very important is called accrual or matching basis of accounting. So everything you will see when we prepare financial statements is taking into account the accrual or matching accounting principle, in effect, which says that we have to reflect revenues and expenses in the accounting period in which they relate to. So you will recognize that expense in the current period only if it generates revenue in that exact period. If you are incurring an expense, for instance, let's say we are paying rent for 3 years right now, right in this year we are. As at the year end, the rent you pay that covers 3 years, how much are we going to recognize of it based on accrual concept in the current period? Let's say there are 3 equal portions. One portion refers to the current year, second portion refers to the next year, and third portion, so 1/3 of the entire amount, to the third year in the future. Obviously, when you prepare year-end accounts for the current period, you are recognizing as an expense only 1/3 of the amount you paid. What happens to the other 2/3? The other 2/3 are, let's say, suspended in a special account called prepayments, so that does not go through an expense account, and it will become an expense. It will come down from prepayments, from the statement of financial position, from the current assets. It will come down in expense gradually. So next 1/3 in the second year, and the final 1/3 in your third year. So that is accrual, matching the expense to the period in which is incurred, and it generates revenue for that period. I think you may have heard about consistency when you looked at your framework document, and of course what we are saying here, we want to make sure we use the same accounting policies from a period to another, the same methods of accounting like depreciation or the way we value stock and so on, from a period to another, to allow comparison. In fact, preparing financial statement is to be providing a good basis for stakeholders to compare your current position with the previous period. This being said, you can go to the next page, page 13. And let's have a look also at the other elements you have there. So you have there materiality and aggregation. So when you present financial statements, again, that you may not have heard, that we haven't touched in the framework document, when you present financial information, you have to focus on what we call material transactions. And thus, if something is completely immaterial, so it doesn't jump a threshold, then you can arguably be non-concerned about it. What does it mean really material then? Are we saying we leave something out? We are saying if an element is omitted, let's say, and that omission is not misleading the stakeholders, would not change their decision anyhow, then that item is considered immaterial. What we have to be careful with materiality is the aggregation side, because you may say, okay, that transaction is €1 and or maybe I have rounded out and I missed on €0.5 or €1. That's immaterial when our business is million or billion dollar. However, if you omitted this transaction and many similar transactions omit this €0.5, you have to make sure on an aggregate basis of all these transactions, it does not become material. So it's no need to present information, we are saying here, about immaterial transactions, but make sure if you aggregate them, suddenly they do not become material, and then you have to recognize them individually as well. Next point we want to make sure we are aware is offsetting. So under financial accounting, you are not supposed to offset a liability and an asset. So if I'm undertaking a service, I'm rendering a service for you, let's say a training service, but you're happy to render for me another service, let's say advertising services, can we offset that? Because obviously I would raise an invoice for you as a revenue for us, and you would raise an invoice for us for advertising services. Can we offset that? Why bother to go through that? Well, the standards do encourage to have as little as possible offsetting, because at the end of the day you want to know and have a good understanding of the assets basis, liability basis segregately. Of course, under exceptional conditions, offsetting may take place, but it's not encouraged. That's what we want to underline. Frequency of reporting, well, most jurisdictions does depend, because on local grounds you may have different requirements, but generally speaking, as a global concept, annual reports, by the name of it, would be prepared annually for all stakeholders. There is some sort of interim reporting every 6 months, but the most important one, where all stakeholders would have an expectation to read annual reports, would be every year. And finally, comparative information. I think you've seen that before in the framework document, to allow a comparison between data. And of course, we'll develop that again. You'll hear about the comparative information in other standards such as IAS 8. This being said, thank you so much for listening for this overview to IAS 1, and good luck with prepping. Look forward to be in touch with you again with the next chapters. All the best.